On board the Inter-Island Line's Arahura, it's half an hour before sailing time. Not surprisingly, most of the attention is directed at the input end of the operation. Just as the focus here is on the input of cars and freight onto this vessel, so government up until recently placed its management focus on the input of cash into government departments. It was the size of the cash input or appropriation that mattered, not so much what was produced. The government was firmly at the helm, controlling the amount of money its departments spent and ensuring the public's funds weren't misused. Unfortunately, what this failed to do was ensure those funds were put to the best possible use. There were no incentives either to reduce costs or introduce efficiencies. Managers were doing their job if the money went where it was supposed to. And of course, if they didn't spend all their allocation, there was always a chance they would get less next year. The situation wasn't helped by departments often not having their objectives clearly defined.
With the Arahura, it's very easy to see what's delivered, in other words, what the outputs are. With government departments, the outputs have been much more uncertain. But government has now embarked on a course of financial management reform, which shifts the emphasis to the output stage of each department's operation and looks at what they deliver for the money they get. That output could be goods or services, policy advice or analysis, or administration of regulations or grants. By evaluating the outputs of departments, it's possible to get a much clearer picture of a department's performance. Like a lot of government departments, the Inter-Island Line provides a range of services for its clients. What these clients want from the services they use is, quite simply, value for money. And it's in the Inter-Island Line's interest to see that they get it. Government has a similar responsibility to see that its departments offer good value for the public's money.
Outcomes is a word that crops up frequently when talking about financial management reform. Outcomes are the effects on the community that the government wants to see happen as a result of its policies, and therefore the results it wants from the outputs from its various departments. It's a bit like New Zealand Railways wanting an outcome of satisfied customers who are getting the freight and travel services they want, and the Inter-Island Line here making an important contribution to that outcome by providing an essential transport link across Cook Strait.
On the Arahura, there's no doubt about where the decision-making authority lies. The captain has ultimate authority on board ship, but is also accountable to the management of the Inter-Island Line. Prior to the 1988 State Sector Act, you would have had difficulty comparing a chief executive of a government department with a ship's captain, since chief executives had only limited decision-making authority and were appointed to their jobs on a permanent basis. But with the passage of the State Sector Act, chief executives now have much more wide-ranging power within their departments and, correspondingly, a greater accountability for the efficient performance of their department.
As a result of the new management reforms, chief executives will be responsible for supplying specific outputs to government through their ministers, and will have their own performance reviewed according to how well their departments have performed. From an accountability point of view, chief executives in government departments are now in a similar position to those in private industry. The business environment, however, differs from private industry in that the owner and the purchaser of their output are normally one and the same, the government.
As owner, the government wants to ensure that each department is making the most efficient use of all the resources at the department's disposal. And as purchaser, the government wants to be sure it's not paying too much for the goods and services provided.
The current financial reforms in government departments are a logical follow-on from the government's drive over the last 5 years for deregulation and efficiency in the economy as a whole. To have overlooked the government's own operations would have meant ignoring the largest player in the economy. Government took its first step in April 1987 with the creation of state-owned enterprises, SOEs. 1988 saw the State Sector Act passed, giving executives of government departments the full powers of an employer and placing them on performance-based contracts. And in July 1989, the Public Finance Act, containing the essential mechanisms to implement financial management reform, was passed. The basic aim of the Public Finance Act 1989 was to cement in the concepts of performance and accountability for government departments, and to specify the sort of information required to assess performance. Financial management reform has definite benefits for government and for the public it serves, but what's in it for the departments themselves? Is it all give and no take? Well, the answer is that there are very real benefits for departments.
Perhaps most importantly, financial management reform gives each government department a far greater freedom to manage its own finances than was previously possible. Once the outputs have been determined through the estimates process and restated in performance agreements between chief executives and their relevant ministers, each department will have a much clearer idea of what's expected of it. This clearer definition will enable departments to combine their planning and budgeting activities and make them more effective. Departments will control their own bank accounts and manage their payments and receipts. In some instances, they can spend the money they get from producing their outputs without the specific approval of Parliament. They will have the flexibility to decide which inputs they should buy and how they use them. And they'll be able to buy and sell assets to produce their outputs.
Of course, it's one thing to be given the go-ahead to tackle a new task. Having the right tools is quite another. In this case, the essential tool is information, timely and accurate information, so that managers know their financial position on a day-to-day basis. One of the keys to this will be the shift to accrual accounting.
The cash-based system of accounting managed to keep track of money coming in and money going out, but that was about its limit. Accrual accounting will enable departments to keep track of the money coming in and going out and relate it to the outputs being produced. Assets and liabilities are monitored so that managers know the real worth of their enterprise and especially any changes to its worth. Short-term creditors and debtors, along with stocks and stores, are managed to minimize the amount of capital required on a day-to-day basis.
By placing the emphasis on financial efficiency, some might think the service concept of government departments will go right out the window. But if you think about it, financial management reform will focus the attention of departments on what they do, how they do it, and how they can do it better. That should result in an improved service. Financial management reform will also enable departments to prove that they're doing a good job and to earn respect for the contribution they make. And what really stands in the way of an efficient government department competing on an equal footing with the private sector and winning?
The intention of the Public Finance Act 1989 is to have all government departments operating on the new system by the 1st of July 1991. But it's not the intention to throw everyone into the deep end. The Act takes account of the wide diversity of government departments and their varying ability to adapt to financial reform. This has led to 3 different modes of appropriation being established. Mode A departments are those which require time to gear up to July 1991. Until that date, their appropriations will continue to be based on the cash needed to buy inputs. The bulk of departments will probably eventually fall into Mode B. In this mode, departments will specify the outputs they intend to produce for the money they spend and adopt accrual accounting. The appropriation for outputs will be related to the cost of producing those outputs. Where departments are trading some outputs in a competitive environment, the appropriations for those outputs will be net of that revenue and hence referred to as Mode B net. Departments which more closely resemble private enterprise operations will come into the Mode C category. They will be required to put a market price on their outputs, pay taxes and dividends, at least notionally as efficiency measures, and also so that valid comparisons can be made between their outputs and those of the private sector. Departments will have a greater degree of managerial freedom in deciding how they go about producing their outputs. And agreement would be reached on a reasonable rate of return on the funds employed.
Until recently, departments had a problem with their budget allocations, namely that they arrived well into the financial year, by which time a large part of the budget had already been spent. That problem has now been lessened with the change in the government's balance date from the 31st of March to June the 30th. The timing, however, of the various phases of the budget cycle and the tax year has not been significantly altered. The new balance date of 30th of June means the government will be able to make expenditure decisions earlier in the annual cycle, while departments will know their allocations much earlier and therefore be able to plan a lot better.
To take full advantage of the more accurate and timely information departments will be able to provide through financial management reform, there have been a number of changes to the content and frequency of government's internal and external reporting. These changes will provide Parliament and the public with a much better assessment of the Crown's activities by showing the full information on service delivery and financial performance. Reporting will now be along these lines. Throughout the year, chief executives, in line with their performance contracts, will report on their department's performance to their ministers, who in turn will provide monthly reports to the Minister of Finance, outlining the department's financial position and explaining any differences between budgeted and actual figures. The Treasury may comment on significant variations from plans. It must also present a consolidated cash flow statement to the Minister of Finance for publication. Every 3 months, the Treasury will produce a summary review of the year to date, giving Cabinet the opportunity to review the remainder of the year and approve any major changes in outputs or resource requirements. Every 6 months, at the end of February and August, departments will prepare financial statements for presentation to Parliament. Those statements will include a statement of financial position and an operating statement, together with statements of cash flows, objectives, specifying classes of outputs and financial performance targets, service performance, comparing the proposed outputs with the outputs actually produced, commitments, contingent liabilities, unappropriated expenditure, and accounting policies. These statements from departments will then form the basis for both the consolidated half-yearly and annual financial statements of the Crown, which, once audited, will be tabled in Parliament.
While it's government's responsibility to determine the direction of its policies and the outputs it requires to meet those policy objectives, financial management reform seeks to put the financial controls of production increasingly into the hands of its departments. Because government is under an obligation to the community it serves to get the best value for its limited resources, it naturally wants to ensure its departments operate as efficiently as possible. And to do that, it needs the means to accurately assess performance. Financial management reform sets up the new machinery to provide that timely and accurate information. But this considerably improved information has a much wider application than just assessment. It goes right to the heart of the way government and its departments do business and creates an environment where departments clearly understand what's expected of them and are given the financial tools and the managerial controls to deliver the goods and services government requires.
By any standards, it's a bold course to take, but one which should see New Zealanders as a whole benefiting from what will be one of the most advanced and responsive public sectors anywhere in the world.